Okay, yeah, in fact, we can go to Pranav Sayta from EY now. Now, the discussion is all about this amendment to the India-Mauritius Tax Treaty that has taken place. This is the second amendment that's happening to this treaty. The first one was in 2016. Now, the latest amendment is talking about introducing what is known as the principal purpose test into the India-Mauritius Treaty. So, does this change the way foreign investment is flowing into India from Mauritius? Well, let's ask Pranav Sayta, International Tax and Transaction Services Leader, EY India. Pranav, thank you so much for being with us. I think since yesterday, the tax circles have been abuzz about what the implications are and whether there will be retrospective applicability. What's your read-through once, you look at that little docket that has been put out?
Sure. So the way I read the language of this particular protocol, I do not think that the language suggests that it will have retrospective application. Having said that, I do recognize that the language is not very happy, and it could, at the ground level, at the tax office level, create a lot of confusion, lack of clarity, and some litigation as well. So I would really urge that some clarification be issued to make it very clear that this will apply only to incomes earned, capital gains, for example, which gets crystallized or exit sale of shares that happens after the date of coming into effect or coming into force of this protocol. That clarification would go a long way in restoring confidence of international investors and bringing clear provisions in the protocol that it will not be affected retrospectively. I don't think that is the intention either of the government, to be fair, but I think a clarification is really something that one would wish for.
Fair enough. But, for an instance, if we read this protocol in the manner in which it's written, because it does say that, it will be applicable without effect to the date on which the taxes were levied or the years in which the taxes were levied. Could it be a material issue if the government at all decides to go back to transactions prior to 2017? And if it's not retrospective, then is it a non-event then in a way, this inclusion of the PPT?
Okay, you mentioned 2017, so let me clarify. There are two aspects of controversy or ambiguity as part of the protocol. One is, does this protocol impact transactions of sale, capital gains, which have crystallized already prior to the date of the protocol coming into force? That aspect of retrospectivity, there is confusion on, and definitely I think it seems unintended, and the government ought to clarify that it will impact only capital gains earned on or after the protocol is notified by both countries. There is a second aspect to the ambiguity here, and that is, as we all know, Mauritius Treaty was amended in 2016 with the result that any investments made after 31st March 2017, capital gains was taxable in India, unlike earlier where it was completely non-taxable in India. Now, when that 2016 amendment came, the government grandfathered all investments or acquisitions that had already been done up to 31st March 2017, and these were grandfathered, so to say. And irrespective of when in future these acquisitions were sold, the capital gain exemption under the treaty, non-taxability in India was almost certainly guaranteed. So investments made before March 17, exits at any time in the future were grandfathered, so to say. Non-taxability in India was a given. This protocol, the second ambiguity that it creates is, will this grandfathering be respected after this protocol, or will the grandfathering also be subject to the Mauritius company fulfilling the principal purpose test? That again is a second controversy, and that again needs to be very clearly clarified by the government. Both are ambiguous from the language of the protocol. The first one, that the protocol applies only for sales exits after the date of protocol coming into effect, I think was the intention to make it effective only prospectively. And therefore, the government should not find it difficult to clarify that. Whether the grandfathered investments, irrespective of when they are transferred, even after the protocol becomes effective, would still enjoy the benefit of grandfathering. That again is not clear from the particular language of the protocol. That I'm not too sure what is the intent of the government, but I would really wish that they respect the grandfathering that was guaranteed in 2016, and therefore shares acquired before March 17 should continue to get the benefit of the treaty without having to go into the principal purpose test fulfillment condition, even after the protocol comes into existence, even if the shares are sold maybe 2 years after today.
Yeah, because the amounts are probably large. I mean, some data that we have show that the total assets under custody at the end of FY17, these are FPI assets, debt and equity put together. That's FDI. Let's move to the FPI table as well. The FPI assets were about 4.65 lakh crores, and as of FY23, that number has come down. These are Mauritius assets I'm talking about, but it's still, fairly significant at 4.18 lakh crores. The total FPI assets under custody, debt and equity, capital markets put together, money coming in from Singapore. This is capital gains, Pranav. Just before we wind up, I want your take also on dividend taxation, because from what I understand, that under the treaty, investors enjoy a more favorable tax regime for dividends, which are paid out by Indian companies. So what happens? For instance, for once, if we just assume that this is not retrospective, it is only prospective, then what happens to both capital gains and the way dividends are getting taxed today for foreign investors?
So dividends, if assuming the protocol is only prospective in effect, dividends that are earned, dividends that are distributed after the protocol comes into effect will be subject to, the treaty benefit will be subject to principal purpose test being met, meaning the Mauritius company will have to demonstrate that the main purpose, one of the main purposes was not just to take tax advantage. One of the main purposes for investing in India through Mauritius was not to take only a tax advantage. Having said that, how dividend works, normally, if the shareholder was a major shareholder, maybe a MNC holding significant stake in India, more than 10%, the dividend will be taxable in India at only 5% in the hands of the overseas shareholder if the shareholder is a Mauritius entity. But for most other public market participants, especially shareholders who hold not more than 10%, the tax rate under the treaty for dividend income from an Indian company is capped at 15%. So instead of 5, it becomes 15%. It's still much lesser than how dividend gets taxed under the domestic tax law, which for foreign shareholders would normally bear tax at 20%. Of course, Indian shareholders would probably pay more, but foreign shareholders under domestic tax law would pay 20%. So in order to get the concessional 15% or 5%, as the case may be, one would now have to show that the one of the principal purposes of investing into India through Mauritius was not to mitigate Indian taxes. That onus will be there to demonstrate that for dividends earned after the protocol becomes effective.
Got it. All right. So investors will have to now prove to the tax department that they are not coming via Mauritius only to avoid paying Indian taxes. Got it, Pranav. Thank you very much. With that, we're completely out of time on this edition of Trading Hour. Do stay tuned. Halftime report is up next.